Hi again. Welcome to another WhamFX training video. In this video, we're hoping to help you understand Forex and all the terminology and all the words that get thrown around in this market. And we'll just jump straight into it. So, terminology. The most common used words, or one of the words that you'll be hearing a lot of, is the spread. So, the spread is just basically displayed in a form of a buy and sell. And the difference between the buy and sell price, which is just annotated there in the black box, that's the spread. So there's a bid price, which is basically the sell price, and then there is an ask price, which is the buy price. So we have them there in the red block as buy and sell, as bid and ask, and the difference between the two is the bid and the ask. So in normal people language, what that means is that the spread is the cost of the trade. So the lower the spread, the cheaper it is, and the cheaper it is to actually trade that pair. The cheapest pair to trade on the market is the Euro USD, the one I've got up there. I took that screenshot on a Sunday. The market was closed, so they would have a wider spread. But on in general, the spread doesn't go any higher on with my broker. It doesn't go any higher than zero point 0.3 pips, which is really good. Other brokers, you can find a spread going anywhere from zero point 0.3 to 2 pips, and all the ones with 2 pips, very high spread, high cost of trading. So when you're looking for a broker, always look for one with like zero spread or very low spread. Low cost of trading means that at the end of the day, you make a little bit more money. So pips. So also same screenshots with the 4 and the 8 annotated in the black block. So pips means it's an acronym, means percentage in points, and the pips is basically the last digit in the value of the currency pair for all the four-digit price feeds. There are brokers that go 5 digits, like this broker over there, but the pip is still four, and then any number after that is just a point. So all pairs except the Japanese yen or JPY are measured in pips from the fourth decimal. Simply put, you actually want to make pips. So the more pips you make, the more money you can make. If you lose pips, you're losing money. So always make sure that you are trading to make pips. Um, be safe with your trades. Make sure you are 100% sure with it, um, and collect those pips. Now we've got pairs. So in pairs, we're always trading currencies. You are trading currencies like Euro USG, which is the European currency versus the US dollar, GBP, which is Great British Pound, versus the USD, AUD, NZD, which is the Australian dollar and the New Zealand dollar. And there are at least 26 other pairs that you can trade. Uh, most of them are majors. There are some minors and exotics. We'll get into that just now as well. So when you do trade, you're exchanging one currency for another simultaneously, meaning that you're buying one currency and selling another at the exact same time. And the difference in this transaction will actually make you money, or it can lose you money if your forecast wasn't correct. Still on pairs, so the first currency is called the base currency. So I'm just going to use my mouse over here. So here we've got the Euro USD. So the Euro is the base currency. That second one is the quote currency. So you buy 1 euro on this day, which was the 27th of March 2016. So you'd buy 1 euro at the cost of 1.1168 US dollars. So if the price goes to 1.12, the euro got stronger and the US dollar got weaker, which would mean that you'd made 32 pips. I'll ask anybody out there, 32 pips is a big deal depending on how much you put down. On this trade, it would actually make quite a good difference. And I think a lot of people are happy with clean pips or positive pips. So if you predict the euro would go weaker, what you would then do is you would sell the euro USD. So you'd be clicking on the left hand side here, click sell, and you're predicting that the price will go down. If it goes down in your direction, you make a profit. If you're predicting that the euro is going to go up, you're gonna click buy. The price goes up, you make pips, you make a profit. Now, if your forecast is incorrect, you'll lose money, and you don't want to lose money. And we will jump into what you need to do, or what you need to do to make sure that you are consistent and your analysis is correct so that you are making more money and supplementing your income or using it as your main income. Um, so back to terminologies. So we talked about majors just briefly earlier on. So there are five main currencies on the market. Those are the GBP, which is the Great British Pound, CHF, which is basically just the Swiss franc, JPY is the Japanese yen, Euro, and the USD, United States dollar. So those are the major currencies. There are other currencies that are on the markets, like the AUD, NZD, South African Rand, which is called the ZAR, ZAR. There's the Russian ruble. There's plenty trades, and they all can be bought and sold. Just have a look at the spread before you buy, because like I said earlier on, the lower the spread, the cheaper it is to trade that pair. The other thing that you have to look out for is just the swap. So a swap is basically a credit or a debit as a result of the daily interest rates. So every country has interest rates, positive or negative in terms of the Japanese yen now. And this happens only when you're holding positions overnight. So I tend to hold positions maybe no longer than 4 days. I close out all my positions on Friday and I can either be credited or debited with the interest rate based on the rate at the time. So what this means is that if the currency that I bought or sold has a good interest rate, I can make a little bit of that on my overall trade, or they'll just uh, deduct that from my overall profit at the time, and that's basically how the swap would work. It's not a big cost at all, especially considering that if you're making a profit over 3-4 days, that swap is very small, very small. Okay, now margin and leverage. So the term margin and leverage is just basically the money required to open up a trade um, or contract in the market. So most brokers come with leverages from either 1:1 or 1:1,000, which is 1,000 is very high. But let's take, for example, you have a leverage of 1:100. So basically what that means is for every $1 you have, your broker is going to give you a leverage of $100. So if you open up a lot size of, let's say one lot size or $1,000, you basically your broker's allowing you to open up a trade of $100,000, which is a big deal. So it means that anybody with no matter the size of your bank account, you can start investing. And this is exactly what trading is. You are investing, and what the leverage helps you do is invest a bigger amount of money with a small amount of initial startup capital. This can be very good in terms of it helps you grow your money in your account quicker. But if you're doing things incorrectly, it'll help you blow your accounts and your money much quicker. So let's discuss what moves the markets. So international trades between companies, those will help move the market. Investment flows. So if countries have a very high interest rate, there will be many investors coming into it, which will boost the country's economy, which will in turn boost the country's currency. Economical and political conditions. So if you're living in a stable country, no economical issues, no political issues, and they are few and far between those countries, your country's economy will be doing very well. Similar to how the American dollar is doing quite well versus many other pairs in the current week or in the last year actually. That's because of mostly economical and political conditions and many investment flows. If you're looking at South Africa on the other side, on the other hand, those economic and political conditions are really bad at the moment, and it's making the country's economy and currency basically go down really badly. Interest rates are also another factor. So the higher the interest rates, of a country, a lot of investors will generally go in if they're going to get a good interest out of it. With lower interest rates, you might see the country's economy or currency value go down. But for some reason, it's not happening with Japan because they've lowered interest rates into negative interest rates, and that's for some reason making the Japanese yen go stronger. But we can jump into the analysis of that much later on. Inflation, GDP, and retail sales. So all of these factors in a country's economy will basically boost the country's currency. So if you know that GDP or retail sales are going to be good, or you've heard that GDP or retail sales and interest rates were good for any currency pair, whether it be the Great British Pound or the US dollar. If you heard that they are good, you would basically be investing in the currency because you know it's going to strengthen. A stronger market, a stronger currency for you means you've made more pips. Once you've made more pips, you're making a lot of way more money. So we will be discussing that in our next videos as well. And if you have any questions, any feedback, if there's anything that you want us to clear up, make a video of, let us know. And that is it for this video. Thanks. Bye.